Assalamualaikum and good morning. Today our group will be presenting an overview of the financial analysis of company M Group Berhad. So company M Group Berhad is a diversified Malaysian company with core activity in property development and construction. Also it's supported by other business segments such as property investment, plantation and building material trading and related service. So over the year, the company has expanded its operation, established a strong presence in this industry. So the purpose of this analysis is to evaluate the financial performance and financial position. So by using the information obtained from its audited financial statement. So this analysis focuses on several key financial ratios, including liquidity, profitability, efficiency, and lastly is solvency ratios. So without further delay, let's us begin with the liquidity ratios.
So the first part of the ratio is liquidity. Liquidity is mainly measured using the current ratio and quick ratio. Firstly, the current ratio compares current asset with current liabilities. From the graph, from the 2020-2024, M Group's Berhad current ratio consistently remained above 1.5, indicating that the company had sufficient short-term asset to cover its short-term liabilities. In particular, the ratio improved significantly in 2024 to around 2, showing a strong liquidity position. This means that for every 1 ringgit of current liabilities, the company had approximately RM2 in current assets, such as a level reflect effective working capital management and reduces the risk of short-term liquidity issues. Secondly, the quick ratio provides a more conservative view of liquidity by excluding inventories which may take time to be converted into cash. Throughout the 5-year period, M Group Berhad's quick ratio remained above 1, indicating that the company was able to meet its immediate obligation even without relying on inventory sales. The most notable improvement occurred in 2034 when the quick ratio increased to approximately 1.79, suggesting improved cash management, stronger receivables, or lower current liabilities. Overall, the liquidity analysis shows that M Group Berhad contains a healthy and improving short-term financial position, especially in recent years. The strong liquidity levels indicate that the company is well positioned to meet its short-term commitments without facing a financial problem.
The next one is profitability ratios. So what is profitability ratios? It's a measurement of company ability to generate profit from its business activities. As we know, this ratio are important because they show how efficiently a company manage its cost, pricing strategy, asset and shareholders fund. So in this analysis of company M Group Berhad, profitability ratios are used to assess the company overall financial performance over the selected period. As we know, higher profitability ratios generally indicate better performance, while the lower one may suggest cost pressure or operational inefficiency. So the main profitability ratio discuss gross profit margin, net profit margin, return on asset, and lastly is return on equity. So we move to the next one. First, the gross profit margin is a measure how much profit the company earns after deducting the cost of goods sold from revenue. For company M Group Berhad, the gross profit margin shows some fluctuations over the years. This indicates that the company has experienced change in production costs and pricing conditions. A higher margin reflects better cost control, while the lower margin suggests rising costs or competitive pressure. Overall, although the margin declined in certain years, the improvement in the most recent years suggests that company M Group Berhad has begun to manage costs more effectively. Right. Next is the net profit margin. Okay, net profit margin show how much net profit the company earns from every ringgit of sale after all expenses, including tax and finance costs. For company M Group Berhad, the profit margin show an improving trend over time, although there were period of decline. This indicates that the company faced operational challenge in certain years, but managed to recover through better cost management and improved performance. So a higher net profit margin reflects stronger overall profitability and better financial efficiency. Okay, next is the return on asset or ROA. Okay, ROA measure how efficiently company M Group Berhad use it in total asset to generate profit. The ROA trend show gradual improvement over the year, which means the company has become more effective in utilizing its asset to generate income. Although there was slight decline in some years, the overall performance indicates improving asset efficiency. Lastly, the return on equity or ROE. Okay, ROE is a measure how well the company generate returns for its shareholders. So company M Group Berhad recorded relatively strong ROE figures, especially in recent years. This shows that the company is able to use shareholders' equity efficiently to generate profit. A higher ROE is generally attractive to investors as it reflects strong management performance and effective use of capital.
The first efficiency ratio analyzed is the inventory turnover ratio, which measure how efficiency M Group Berhad converts its inventory into sales. A higher inventory turnover ratio indicates faster movement of inventory, lower holding costs, and stronger operational efficiency. Over the 5-year period from 2020 to 2024, M Group Berhad inventory turnover ratio shows a generally improved trend. In 2020 and 2021, inventory turnover was relatively lower, reflecting slower sales of property units and longer inventory holding periods. This can be linked to weaker market conditions and the lingering effects of the post-pandemic recovery, which affected demand in the property sector. However, from 2022 onwards, inventory turnover began to improve. This improvement became more significant in 2023 and 2024, where the ratio reached its level highest best during the period. This suggests that M Group Berhad became more effective in clearing completed developments, reducing unsold stock, and responding to better market demand. Overall, the upward trend in inventory turnover indicates improved inventory management, reduced holding costs, and stronger operational efficiency for M Group Berhad in recent years. The second efficiency ratio analyzed is the debtor turnover ratio, which measures how efficiently M Group Berhad collects all payment from its customer. A higher debtor turnover reflects faster collection of receivables and stronger cash flow management. Between 2020 and 2021, M Group Berhad debtor turnover ratio showed relatively stable performance, indicates that the company was able to collect receivables within a reasonable time frame. However, from 2022 onwards, debtor turnover ratio began to decline. This decline became more noticeable in 2023 and 2024. It indicates that customers were taking longer to settle the balance. As a result, the average collection period increased, placing additional pressure on the company operating cash flow. The weakening debtor turnover may due to softer market condition, extended payment terms offered to buyer, or higher proportion of sales involving project within longer cycling billing. Overall, while M Group Berhad has improved its inventory efficiency, the declining debtor turnover highlights the need for stronger credit control and receivables management to avoid potential cash flow constraints.
Okay, so let's moving on to the solvency analysis. This section evaluates M Group Berhad's ability to meet its long-term obligation and assesses the company's financial risk and capital structure. The main ratio used in this analysis are the debt to equity ratio and the interest coverage ratio. For the first part is the debt to equity ratio, measures the proportion of debt financing relative to shareholders' equity. Over the period from 2020 to 2024, M Group Berhad's debt to equity ratio remained below than 1, indicating that equity financing exceeded debt financing. The ratio showed a generally declining trend, reaching its lowest level in 2024 at approximately 0.72. This suggests that the company has reduced its reliance on debt and strengthened its equity base, resulting in lower financial risk and improved long-term financial stability. For secondly, the interest coverage ratio assesses the company's ability to pay interest expenses using its operating profit. M Group Berhad maintained a strong interest coverage ratio throughout the 5-year period, ranging between 6 to 12 times. The highest interest coverage was recorded in 2022, indicating that operating profits were more than sufficient to cover finance costs. Although there was a slight decline in 2023, the ratio improved again in 2024, showing that the company remains capable of servicing its debt comfortably. In conclusion, the solvency analysis indicates that M Group Berhad has a stable and conservative capital structure, with manageable debt levels and strong earning capacity to meet long-term financial obligation. This reflects prudent financial management and a low level of solvency risk.
In conclusion, the financial analysis of M Group Berhad from 2020 to 2024 indicates that the company maintains an overall stable financial position. The liquidity analysis shows that the company is able to meet its short-term obligation comfortably, reflecting effective working capital management. Profitability performance fluctuated over the 5-year period, with the stronger result recorded in 2022, followed by a decline in 2023 and partially recovery in 2024. This suggests that while M Group Berhad remains profitable, its earnings are sensitive to market condition and cost structure within the project industry. Efficiency analysis reveals improving inventory management in recent years. However, declining debtor turnover indicates lower receivable collections, which may place pressure on operating cash flow if not addressed. From a solvency perspective, the company maintains a conservative capital structure with manageable debt level and stronger interest coverage. Overall, M Group Berhad is financially stable but continue focus on improving profitability. Consistency and receivables management is essential to support sustainably long-term growth.